The gold price has ticked higher today in pre-weekend London trading, following a cross-complex washout in the previous session that reflected the fading run of bullish factors currently in the market. Spot gold was last seen around $1,260 per ounce, having spent most of the week near $1,300. Yesterday, however, it dropped nearly 2.7% at one stage to a two-week low, as investors liquidated positions with the January rally coming to an end. Silver also recorded large losses, slumping as much as 7% at one stage, also to a two-week low. Gold had rallied as much as 10%, however, at one stage this month, bolstered by a range of bullish factors, including uncertainty in the eurozone, the Greek elections, and more importantly, the prospect of a delayed US interest rate rise due to global growth concerns and falling oil prices. The final factor, however, was Wednesday's Federal Open Market Committee meeting, which said that it can be patient in beginning to normalise the stance of monetary policy, words that should fuel speculation that the prospect of a near-term interest rate increase has diminished. It should be good for gold in the near term. Furthermore, the committee made some small tweaks to its statement that indicate that the economy is finally healing. However, not only did it remove considerable time from its language on tightening, but it also noted that economic activity has expanded at what it called a solid pace, which is an upgrade from moderate pace in the previous statement. But, as anticipated, the Fed noted that the lower energy prices had caused inflation to dip further below the objective of 2%. Still, the central bank still expects inflation to move towards this target over the medium term, as slack from the labour market continues to dissipate. In other data today, eurozone inflation dropped to its lowest since July 2009 at minus 0.6%, down from minus 0.2% in December, as plummeting oil prices continue to take their toll on Europe. The headline, though, is the core figure, which strips out the volatile elements of food and fuel at 0.5%, also missed forecasts. Today's US GDP figure at 2.6% was the smallest increase since the first quarter of 2014, though the figure is likely to have been affected by the slowdown in Europe. Elsewhere in physical buying, Chinese demand is beginning to slow, according to sources, ahead of the Lunar New Year in February. Nonetheless, Shanghai Gold Exchange withdrawals last week equalled a one-year high for the second consecutive week. In the meantime, Chinese buying should support gold prices over the next couple of weeks, with the Lunar New Year coming in 19 days later than last year, although Indian buying has almost ground to a halt. This is Ian Walker reporting for the Bullion Desk down here at the London Metal Exchange.